Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. I believe this is part 4 of this particular panel, which has been very popular. Of course, we've got Lobo Tiggre from the Independent Speculator. We've got Rick Rule, CEO of Rule Investment Media, and the host of the Rule Symposium. Happening right now as you're watching this. It's from July 7th to 11th. You can still catch it online. You can still catch the replay. We're going to talk about that a little bit later. But for now, gentlemen, it's great to have you both back once again on the show.
Pleasure. Always fun.
Well, let's start with a simple question, and that is, which areas of the commodities sector at present do you think presents the greatest value proposition, and how are you positioning yourself to capitalize? Lobo, I'll start with you.
I'm going to have to go with copper. That's been my top call for 2025. And people have been wrongly congratulating me on that because copper hit an all-time high earlier this year, but not for the reasons that I gave. So maybe you should stop listening to me then. But I think all those reasons I gave are still in front of us, and going into that from a higher cost base or a price level, I think that just adds to the upside. And the thing that I like about, I'm bullish on many things. I could, other metals and minerals are high on my list. But the thing that I like about copper is that it really is straight. The structural supply constraints here are so real, so big. That pipeline is so close to dry for years and decades to come. It's just an extremely strong thesis. And I think we're getting to that push comes to shove moment. My only concern is in the very near term, we still have plenty of trade war issues, actual war issues, Trump shock ahead to deal with, and Dr. Copper is economically sensitive. So I think there's potential for near-term weakness, which I would absolutely see as a gift from Mr. Market, a buying opportunity, and I am saving up cash for that.
And really quickly before we move on, why did copper hit all-time highs, and why did that not align with
for
your
the
thesis?
Wrong reasons? Trump didn't even announce a copper tariff. He announced, he signed an executive order. We're going to look at copper. We're going to study it. Oh, great. You remember when they studied uranium? That took years, and then they did bupkis. Sorry, but the fact is it was actually Biden that implemented the Trump study group idea of uranium, of establishing that uranium reserve, and funded it, or started it anyway. So, a study group doesn't excite me, and maybe it's a coincidence, but that's all that really happened in the market at that time. What's happening now, I think, is more real. It's got more of my attention. I'm still worried about Dr. Copper in the nearest term, but when the LME stocks go, way down, and China's having to, trouble getting its smelters to work right. I mean, they're very excited because they just got to zero smelting charges. That tells you something about the market. So I'm really, really very keen, and I don't claim to be able to time the market. I just have this feeling, though, that the time to buy is in front of us rather than behind us. If I'm wrong, I'll still have years, I think, and decades to make money on this trade. If you're very patient and you can handle the kind of drawdowns that have resulted in Rick having less hair than me at this time on the way, Rick will tell you all of my big wins have had 50% drawdowns on the way. If you can handle that, and you think copper is likely to, the bottom is behind us, then don't wait for me. Go ahead. I think that is so solid that I would go ahead. But it's Dr. Copper. I just can't get it out of my head that the other shoe is yet to drop on the retooling of the American economy that the president is trying to ram through. And that will have consequences that I think will create a buying opportunity.
And Rick, what are you watching the most right now when it comes to the commodity sector? What do you think is presenting the greatest value proposition?
The answer to the question is really a function of the investor's time frame. If the investor's time frame is short, I think that the gold stocks and the silver stocks have to catch up to the gold price and the silver price. I think we are in a conventional precious metals bull market, which is led by the metal. After the metal, the best of the best follow, and then the best of the rest follow. So if the investor is asking me the question from the point of view of a 1 year time frame, I think the gold and the silver equities are likely the place to be. I'm not positioning there because I'm positioned. I have this paper coming out of every available orifice, horrible image, but that's the way it is. I agree a lot with Lobo with regards to copper. I like the copper business because there's any number of copper mines in the world that make $2 or $3 million a day. And I have a fondness for big, big, big deposits as opposed to small deposits. The copper business has treated me extraordinarily well for 40 years, so I'm predisposed to it. I'm a bit more cautious than Lobo, which is unusual, in the near term about the economy. I'm not an economist, but I note that the oil price falls even on flat oil production. That tells me something about near-term demand in the economy, not what people are looking to in the future. But I would agree with Lobo that to the extent that we see copper weakness as a consequence of the global economy, that we view this as a gift. If you look out further, for every reason in the world needs more types of power of all types. And copper is how you get it. Well, it's how you generate it. It's how you get it from where it is to where it's needed, and it's how you use it. There's 1 billion people on Earth with no access to primary electricity. Those are all copper buyers, whether they know it or not. And we all want to use more energy. It makes our life better. My own particular thesis is that I'm a commodity agnostic. I like great big deposits, tier one deposits, sort of $20 billion in net present value at today's prices, in recoverable reserves and resources. And I don't care about the commodity. What that means is that I'm looking at tier one deposits in out of favor countries in out of favor commodities. Things like rare earths in Brazil, things like rutile and graphite in Zambia. 6 months ago, before it became popular again, platinum and palladium in Brazil. I have a huge fondness for great big deposits in out of favor commodities in out of favor countries where the market ignores it. The idea that there is a deposit that could in 5 years be worth $2 or $3 billion that has a market cap of $50 or $60 million today is particularly seductive to me because I've enjoyed it so often in the past.
Let's talk about
gold. I know you got a bunch of questions,
ahead,
but let me jump in on this gift point because I think this is really important. It's something that Rick and I have both seen in our careers. And we've had a recent example, and that was in the uranium space, another area that I know Rick and I agree on. When uranium sort of bottomed out recently, and the stocks held up because the uranium story is so strong. Everybody sees it. The demand case is so high. Even skeptics have so the uranium stocks were kind of holding up, even though spot uranium was going down. And then that DeepSeek thing came out of China, and everybody's, oh my gosh, AI is not going to need all this energy, and uranium stocks cratered. That was absolutely a gift. I mean, it was a sell-off for completely the wrong reason. Uranium went up to 80, 100, before the AI craze kicked into high gear. The AI story was never the reason for owning uranium stocks. It became an purely optional bolt-on tailwind at some point, and its disappearance made no difference, none, zero whatsoever to the investment thesis for this still necessary, no substitutions. Sorry, thorium fans, not anytime soon, right? You've got to have it, or as Rick says, the lights will go out in large swaths of the world, and it goes on sale for completely hype-driven, wrong reasons. An absolute gift. And I'm sure Rick and I both highlighted this to our clients, and anybody who listened and bought a couple months ago is sitting pretty on nice gains already. A very large cap uranium go-to company that we all know, and I won't name, was looking at 52-week lows at that point and has now reached all-time highs in just a couple months. So I mean, this is what I mean by a gift. And this doesn't happen every day or even every year. But when the market hands you stupid cheap prices for completely the wrong reason, I think Rick and I can compete on who's the most avaricious at that point.
I would note with regards to uranium that I've accepted that gift. My trading position in uranium stocks, not my core position, but my trading position in the uranium stocks belongs to somebody else now. 6 months ago, those stocks were so cheap, you could look at the discussion groups and see that people who had uranium as a component of their internet handle were moaning about ever having been in the trade. It was as delightful a period of hate as I've ever seen. So I strapped on some positions myself just as a consequence of the hate. I've learned in my career, if the reason to own a position goes away, the position needs to go away too. So while I own my core uranium position, which by the way is an immodest position, my trading position now belongs to somebody else. When you are given a gift, depending on the nature of the gift and depending on your own orientation, you need to remember to take it.
Yeah, that's a very good point. And we are going to dive into uranium a little bit deeper in a moment. First, I want to get your thoughts on the gold mining sector here, because as gold reached all-time highs, nominal highs, of course, we didn't see the stocks perform like many people expected them to. People expected the gold stocks to act as a levered play on the gold price itself. That didn't fully materialize. However, now, so far year to date, we're seeing the GDX and especially the GDXJ outperforming the metal itself by quite a wide margin. It looks like a lot of these stocks are starting to wake up. I wonder what both of your thoughts are there. I spoke to Adrian Day recently. He said even a company like Agnico Eagle is still quite tremendously undervalued, despite the fact that it's near all-time highs based on its cash flows, based on its gold reserves. I wonder what both your thoughts are on the majors and then going down the chain into developers and the exploration space as well. Lobo, I'll start with you.
The thesis that the gold stocks were broken is one that was really a 2024 story. And I wrote about it just over a year ago, arguing that they weren't broken, but that as my mentor, Rick Rule, taught us so well, the gold producers in the last big gold bull market managed to turn a 7-fold increase in the underlying commodity into an increase in negative free cash flow. And I went and charted that. It's true. Like he likes to say that took real talent. I'm bringing Rick into my answer here, but I think this is highly material. So the intelligent investor, assuming there are 2 or 3 left still alive, it wouldn't be wrong for them to hesitate before saying, oh, gee, gold's up, gold stocks should go up. The last time, they turned it into greater negative free cash flow. Why would you buy that business? Or as my other mentor, Doug Casey, says, it's a crappy choo-choo train 19th century industry. Why would you invest in that today if your most recent experience with it is a dramatic underperformance? So flash forward to this year, and not only do we have the higher gold dollar exchange rate, I don't like to call it the gold price because in my mind, gold is money. So it's a Forex question. The higher gold dollar exchange rate, it's not just that has pushed up the miners. The miners have actually started delivering. Agnico, as you mentioned, known for excellence of operations, it actually was outperforming even last year. And the other ones that have problems, not so much. And that kept the GDX underperforming. Well, this year, even last year's underperformers are benefiting from the margins, and some of them are actually getting their act together. And so, I mean, it makes sense. The business is actually delivering. And so those people who previously said, well, the gold miners, they flubbed it last time, they dropped the ball. Well, this time they're actually running with the ball. There's a rational basis for saying that, well, now it makes sense. And then, of course, the food chain, the trickle down theory, that actually does work in the mining space. We've seen this repeatedly. So I will push back a little bit on my mentor here and say that the obviously better companies have responded with gusto here. So it's really difficult for me to look the audience in the eye and say, yeah, never mind $3,300, $3,400 gold in all-time highs, not just 52-week highs, but all-time highs in a stock like Agnico or something like that. Just buy it. It'll be fine. There is opportunity for correction. And the idea is to buy low, sell high, not to buy high and hope to heck to sell even higher. So as much as I love a company like Agnico, I would buy that today at an all-time high or very near to that. I would look for something that is legitimately still overlooked. And this requires due diligence. This is a stock picker's market now, is basically what I'm saying. I wouldn't buy an ETF. I wouldn't buy the GDX or the misnamed GDXJ. I would look for something that is legitimately bringing value to the market, which hasn't caught on yet. And those do exist. They're out there. But there are ones that you can't say, oh, it's cheap, so that's an overlooked gem. No, there are stocks that are cheap and they deserve to be cheap, right? Lifestyle companies and that sort of thing. So again, caveat emptor, buyer beware. This is a stock picker's market. But if you're willing to do a little work, and hey, if you want to make money, you should be willing to do a little bit of work, maybe a lot of work. I do think that there's still, I'm agreeing with Rick, there's still opportunities in the gold and silver stocks. But I do think it requires effort here, no dart throwing.
And Rick, your thoughts on the gold mining space at present and the opportunity presented by the majors and also further down the value chain into developers and explorers?
Well, I would respond to Lobo by saying it's always required effort. And what he says about the sector as a whole couldn't be more true. There's probably 1,000 public companies worldwide that purport to be in the gold space, but most of them only have gold as a component of the name on the share certificate. If a commodity rises that you have none of, it shouldn't impact your basic values. And the great majority of the purported gold mining stocks will ultimately return to their intrinsic value, which is zero. Investors make fun of sovereign issuers for inflating away the currency, but there's no industry in the world that's better at inflation, which is to say printing phony paper, than the gold mining industry. That disguises the fact that there are qualitatively better companies now than there were in the decade 2000 to 2010. Remember that the most flagrant abusers in that epoch were allowed to pursue other employment opportunities, hopefully in other industries. I would argue further, as an example, with Agnico Eagle, and we've done the work. If you do a net present value calculation on their future cash flows at $3,200 gold and compare it with the net present value of future cash flows that existed 18 months ago when the stocks were half as high, they're actually cheaper today than they were 18 months ago on a net present value basis. Both Lobo and I have the experience, we have the courage, and we're willing to do the work. So we can go down, further down the feeding chain than most people do. However, if we're talking to a broad audience, which I know the VRIC has, the truth is that most of the population under-owns the gold trade. And just capturing the beta, just capturing the amount by which the gold market outperforms the broad market in a gold bull market, argues that investors who aren't willing to do the work, who can't suffer volatility, too much volatility, and can't suffer real risk, need to be in the best end of the market. Bull markets follow very, very predictable patterns. The metal, the best of the best of the rest. The junior producers, the developers, the explorers. That's the way it works. For myself, I'm moving way, way, way down the value chain. I'm trying to get as far away from the institutional investors, from the traders, from the ETFs as I possibly can, so that I can acquire large positions in companies that will be acquired and added to the index. That's the way the game works. But this is a game that requires a lot of work. And I have learned at my conference and your conference that most investors are unwilling to do the work required. Most investors would prefer to feel as opposed to think. For them, they need to be in very, very high quality names.
That makes a ton of sense. I want to dive deeper into uranium now because, as we talked about, there was a slump for basically no real reason that made sense when it comes to the investment thesis. Now we've seen URNM up over 60% since the lows this year in April, and bullish news keeps piling up in a sector that already has a tremendous amount of tailwinds behind it. I think the most bearish thing going for the uranium sector right now is that Jim Cramer has recently come out and said, buy everything uranium, which has caused me some consternation. I hope the Cramer effect does not play out. Which areas of the uranium market right now do you think could provide the greatest upside? And how do you separate the companies that are strong contenders from those that are more of a gamble? Obviously, there's only two really big producers that are publicly traded in Cameco and Kazatomprom. I think Orano is listed on the France Stock Exchange. But besides that, there's not many companies producing anything in sizable quantity. So how do you evaluate these companies and kind of separate the wheat from the chaff, Lobo?
Well, this is another one where, it was easier a couple months ago when everything was on sale, where the best was along, with the DREC out there. Now, again, you have to be a stock picker. And how do you do that? Well, there's two paths. One is you just go with the thesis that uranium's going higher, and you buy the best because they will go higher. Whether, whatever the valuation is, and it hurts me to even say that, but whatever the valuation is, if the metal goes higher, the go-to companies and the obvious winners, the high grade or high margin stories, the developers that are making good progress, those will all move. There's no doubt in my mind that that'll happen. But it's not my nature, as I was just saying about gold, to buy high and hope to sell even higher. So I'm going to do the extra work and look for something that seems overlooked for some reason. And maybe it's a new story. Maybe there's a land consolidation story, something like that. Or, somebody takes an asset that was unloved in a larger company, and now in their company, it makes sense. And they've done the work that the larger company didn't do. Something like some credible reason for why this actually is an overlooked gem and not a piece of beep that deserves to be overlooked, right? So due diligence, I think, is required. So if you're not willing to buy high and hope to sell higher, and you don't have the time or the team that people like Rick and I do to do this due diligence, the other option is just to wait for the next fluctuation. Mr. Market is a cycle. He flips and flops from manic to depressive. There's always another depressive. I mean, we just saw a couple months ago the market sell off for the wrong reason. Maybe there's a blow up between Elon and Trump. We'll have everybody, saying, "Oh, EVs are done, and therefore sell uranium." Right? It would be wrongheaded, but I could see that happening just because Mr. Market loves a narrative, right? So, if you're really not sure what to do, then maybe that's the easiest thing to do. Wait for that other shoe to drop. Can't kiss all the girls, as Doug likes to say. Just wait for the next time for the music to bring the right one around.
And Rick, how are you viewing go ahead. Yeah.
Well, following on to Lobo, most of the girls are ugly. So there's no point in trying to kiss them all. There's plus or minus 100 junior companies that purport to be in the uranium space. And we've found 13 that we think are viable. So kissing all the pretty girls absolutely, positively guarantees that you'll get a social disease. No way around that. I would argue again that if the structural changes in the uranium market play out the way I think that they're going to, the biggest and the best are not expensive. They're cheap. Particularly if Cameco can make the Westinghouse acquisition work. I was really afraid of Cameco taking over Westinghouse because I was nervous about how a mining company could operate an engineering company. And the first couple of quarters, my worst fears were realized. The last couple of quarters, however, have given me pause. Around Cameco, it's more about the structure of sales contracts in the term market and the operation of Westinghouse, their vision of building an integrated company that doesn't merely produce uranium, but rather sells watts. Truly spectacular vision if they can pull it off. Coming down, it's really all about utilizing the term market to lower your cost of capital. Not 1 in 1,000 speculators understands the significance of the term market. In uranium, unlike any other commodity in the world, you can enter into a contract with an investment grade counterparty, Southern Company, Duke Company, Duke Power, Tokyo Electric Power, China General Nuclear, that specifies price and terms with accelerators over 10 years, 15 years, 20 years. What that means is that your lenders have a real sense of your revenues and your margins. That doesn't happen in any other commodity business in the world. It also means that lazy securities analysts, say Rick Rule, can construct rudimentary cash flow models knowing about price and volume. I can't do that in the gold business. I can't do it in the copper business. I can't do it in the oil and gas business. It's going to take 3 or 4 years, maybe 5 years. I don't know. For the equity market to insist that the issuers are more transparent about the terms of their contracts. But those who do will enjoy the lowest cost of capital relative to the risks involved of any commodity producers on the planet. And this is a profound change.
I want to talk about oil and gas briefly here because the conflict between Israel and Iran, the 12-day war, whatever you want to call it, so far we've seen a ceasefire that seems to be holding tenuously. It did send oil prices surging on worries that the Strait of Hormuz was going to get closed, that some of Iran's oil production was going to get affected for the long term. A lot of the people thought the price move would be much more significant to the upside. I think prior to that, a lot of people would say, well, we'd see triple digit oil if some sort of war breaks out in the Middle East. Um, why do you think that oil prices have since collapsed back down? What do you think about the trajectory of the oil price over the long term? And is there a lesson to be learned here that trying to trade or invest on headlines in the news is kind of a fool's errand? Rick, I'll start with you on this one because I know you love the oil and gas business a bit more than Lobo.
Well,
He taught me.
both Lobo and I share a former mentor, Doug Casey. And Doug Casey has an unheralded journalist's understanding of how a story would impact a market. People who understand the impact of a story on popular opinion, Doug is one, can trade headlines and can trade the possibility of headlines. I'm uniquely bad at that. I don't own a TV. I don't know how to dress myself. There's no worse analyst of the impact of a story on popular opinion than me. So I don't do that. I do arithmetic. When the oil price tells me two things, it tells me in the very, very near term that demand isn't expected to falter. Demand is faltering real time because you don't store oil like you store copper or you store uranium or store gold. You burn it. And the softness in prices in the face of steady, not increasing production, tells me that in the very near term, demand is really, really, really problematic. If the Iranians had put a missile into a ship in the Straits of Hormuz, where 60% of the world's export crude travels, believe me, you would have seen another digit on the oil price. The world was betting, it looks like, hopefully, correctly, that that wouldn't occur. But that ignores a much bigger story. The bigger story is that the underinvestment by the world's oil industry in sustaining capital investments has grown from $1 billion a day to $2 billion a day. The industry as a whole, particularly the parastatal companies, are underinvesting in sustaining capital to the tune of $2 billion a day. You can get away with this for 6 months or 12 months or 18 months, maybe even 24 months. But over time, deferred sustaining capital investments, never mind new project investments, restrict your ability to maintain production. That's just what happens. The other thing is that I think we've learned that the big thinkers of the world with regards to energy, my favorite energy physicist, Greta Thunberg, Joe Biden, Angela Merkel, Justin Trudeau, all these people who thought that peak oil demand would occur in 2030 were as wrong about that as they were everything else. It occurs to me that peak oil demand likely occurs in 2060. 2065. What that means is that when the securities analysts do net present value calculations on oil, they aren't giving them any value to the production tail whatsoever. And the production tail is going to be extremely important. On somebody like Exxon, with 30 years of reserve life, when you do a net present value calculation that makes all of the value accruing after year 10 valueless, what happens after year 10 is that you restart the net present value cycle at the same price you started it at. And the idea that you don't assign value to that tail is just flat stupid. To the extent that your audience is partly or largely Canadian, I think the wild card there is Carney. It's interesting to me that the Liberal Party ran on a platform for change, having been in office for a decade. And I would argue that the only thing that kept Canada from truly superior performance in the oil and gas business was Ottawa. The hope is that Mr. Carney, despite the fact that he is anti-carbon and has said that he will put carbon as the centerpiece of his financial policy, one would hope that he is pragmatic enough to know that Canada should develop its best industry if they have any hope of financing his stupidity. And my hope is that he will be pragmatic enough that Canadian energy development can continue to the extent that if he ever tables a budget, he'll have some hope of balancing it.
And Lobo, what are your thoughts on the price action of WTI crude in the aftermath of the Israel's attack on Iran? I know that at the moment you're hands off when it comes to hydrocarbon investments. You're waiting to see about a potential recession up ahead. You mentioned that a lot in your newsletter. Unpack that for us.
Couple thoughts. I'll see if I can keep these straight in my mind. I want to come back to the timing on this because it highlights something that's come up in this conversation a couple times already. But the direct answer to your thing is there was like, what a lesson. You asked about headline risk and trading on the headlines. Saturday, we get the word that the United States is bombing Iran. Like, if you had told me that was going to be the headline a year earlier, I would have said triple digit oil around the corner. Like, who wouldn't have thought that? The United States is going to freaking bomb Iran? Like, jump into that quagmire. And so Saturday, we get this news: the United States is bombing Iran. And thank goodness the oil markets are closed, because I would have thought, if they were open, I might have, even I, who normally am pretty cautious about these things, might have said, well, there's no way. I mean, this is just, oil's got to go up. I'm going to jump on that bandwagon. But fortunately, the markets were closed. And then by the time Monday comes around, or Sunday night, and futures start trading, it seems like somehow this didn't result in World War III. And more importantly, Iran's response to fire, half-hearted missile at a U.S. airbase and warn us beforehand. As Bloomberg liked to says, the whole thing started to look rather performative.
Yeah.
And so, what happens Monday? Oil goes down, right? So if you had this knee-jerk reaction, oh my gosh, the United States is bombing Iran, oil's going to triple digits, buy, like a certain TV personality with this big red buy button, right? If you had done that, you would have been taken to the cleaners in very short order. So I do think there's a lesson here, and this goes to maybe the bigger issue that I'm alluding to, and there are some apparent differences in Rick's answers and mine. And it's not that we are really at that much loggerheads, but Rick being Rick and having the status with his clientele, if you will, he has staying power. He could open a 7-year closed-end fund that nobody could take their money out. Like, he wouldn't have to worry about being the big short guy, right? Because people trust him that much. And so he can ride out the bumps, and he can have the long-term view, like he just expounded on oil, and deliver money for over the years. I'm just an evil scum of the earth newsletter writer. And my clients want to know, what have you done for me lately? And that usually means 6 to 12 months, maybe 18 to 24 for longtime readers, right? So I need to care a lot about what's happening now, not what's inevitable or not what's imminent, but what's happening now. And that's why, so like on the copper issue that we talked about before, it's not that we really disagree. It's just that if I say, let's just buy copper, and it drops, and the stocks drop 50% in the quarter or two ahead, Rick can weather that storm in a different way than I can. Same with the uranium story that we just talked about, and same with oil that we're talking about now. So my overall view is completely in sync with Rick's. We're going to need the oil. The underinvestment in the industry assures higher prices going ahead. I do think we will reach a world where triple-digit oil prices will be the new normal for a long time. But until we get there, you've got OPEC opening up the floodgates again, even at a time of low prices. This does not give me reason for optimism. Unlike copper, this is not an industry that is currently looking at structural supply constraints. It is under voluntary supply constraints. So that makes me cautious as an evil scum of the earth newsletter writer in the very nearest term.
Great summary from both of you. I want to ask a question when it comes to evaluating mining stocks in general, and that is the subject of geographic diversification. So obviously it depends on the commodity, the size of the company, a lot of different things. But when you're evaluating mining stocks, do you look for a company that has projects in multiple jurisdictions to cut down on jurisdictional risk? Do you value such companies over a company that might have only one asset? I know it's a multifaceted question, but I'm just wondering how you view that issue when you're evaluating mining stocks. And Rick, I'll start with you.
Jesse, I could care less about story. I look for companies that have a management team with a proven track record of success in the task at hand. If somebody has been successful developing copper gold porphyries in the South American Cordillera, I want to buy a company where a proven team is developing a copper gold porphyry in the Chilean Cordillera. As I age, increasingly attracted to the Buffett thesis that ideally you would put all your eggs in one basket and watch that basket very closely. I have never been as good at stock picking as Mr. Buffett, so I've always had to have some diversification to protect myself from myself. But selection in earlier stage companies around people, and people is important. And it isn't just people, it's people performing tasks that they are proven to be successful at. I can't stress that enough. As the company matures, you can take other things into consideration. But this theme, pick a theme, diversification, anything like that. It's less important than an incented team engaged in a task where they are proven outperformers. Look at the success of the Lundins right now in NGEX. What are they doing? They're exploring the Argentine Altiplano. They've been doing that now for 3 decades. The team who is doing it for them has been doing it for them for 25 years. They have worked, if you will, 3 decades to be an overnight success. And I've watched this happen time and time and time again. I've watched the Ross Beatties of the world, the Bob Quartermains of the world, the Robert Friedlands of the world, the Lundins of the world. I've watched these people from humble starts with companies deliver serious outcomes. And if you're going to come down the quality trail, which both Lobo and I love to do, start the game with people, not story. Let the people tell the stories.
Great words of wisdom there. Lobo, your thoughts on the concept of geographic diversification. Does that reduce any jurisdictional risk in your view?
Just to be clear here, Rick's answer might almost sound sideways. What he was saying is this is much more important than the geographical risk.
Yes.
So,
yeah.
He didn't care about the geographical risk if it's the right team doing the right stuff that they know how to do and have delivered before. Sorry for paraphrasing there, but this is important because this is an area where I do have, I think, a significant disagreement with Rick. And maybe it's, again, related to that time frame thing where he has the staying power that I don't as a newsletter writer. But I am, or maybe it's just my personality. I like breakout in hives at the wrong kind of political risk. Coup d'etats, multiple coup d'etats in the same place really bother me. Places where you have to have the army protect your expats and so on, and everybody else on your operating site, that makes me nervous. And it's the kind of thing where you can wake up in the morning to a serious loss of capital on the wrong news, and there's no recourse. Like maybe with Rick's patience, 5-10 years later, you recover and you end up with a big win. That Tenke Fungurume in the Lundin family was one that took a lot of patience, like decades of patience and civil wars, and it eventually turned into a big win. That's not something that a newsletter writer can survive, an investment that goes sideways to down for so long in such a huge way. And I don't think the average investor out there has the intestinal fortitude to do that either. They should stick with the safer end of the barbell. So I see Rick nodding, so I'm not throwing him under the bus here, but we have a different perspective, I think, for reasons here. And so personally, I do look at political risk a lot in my portfolio. And, if a place has just had a coup, that's an absolute no-go zone for me, even if it doesn't have anything to do with mining and the junta says, oh yeah, we want the mining to continue because we want the tax revenue. That's today. Who knows what they'll do tomorrow? I mean, just look at what's going on with Mali, for example, of rug pulls and rule changes and things. And the other thing is, well, I won't beat it to death. I do think this is important. But to your question, though, Multi-asset diversification kind of helps, but not much. If you've got a big mine in some country that just goes bananas, it's going to hurt. I mean, look what happened to Franco-Nevada, which isn't even a miner. It's a royalty company, supposedly safe, right, from operational difficulties because they just collect the royalty. And then Cobre Panama happens, right? So to me, in my investment time frame, in my business model, this is material. And it's a big problem for me if I tell everybody, don't worry about it, it's fine over the long run, and then they get hurt and they don't have the intestinal fortitude to ride that shock out or actually see it as a buying opportunity. So this matters to me a lot. Diversification kind of helps a little, but generally I just avoid, obvious danger spots. There are no-fly zones for my money, and I say so to my clients. Oh, sorry. One other thing on the single asset thing, the pre-production sweet spot, my favorite form of investing, or single asset producers that are profitable and obvious takeover targets, another, obvious way to put the odds in your favor. There are reasons why, sometimes a single asset story is actually a good thing. Doug used to call them one-trick ponies. That was a risk, but they can facilitate a big win under the right circumstances. But if that's in the wrong country, right? So, you can't diversify that. So yes, country risk is a big part of my personal stock selection criteria.
I would agree with Lobo. Every country's bad. The government that's closest to you
can run, but you can't hide, as Doug says.
The most money I ever lost to political risk was in the People's Republic of California, where I was a resident. The country that's treated me best in terms of cash in, cash out, personally, was Congo. It's odd that I would, to this day, prefer to invest in Congo than in California. Part of that is perspective and need, as Lobo suggests. I was able to deliver pretty good gains to clients in the early part of the decade of the 2000s, as an example, taking a lot of political risk. And I took shit every quarter for the volatility in the portfolio and for people who didn't understand what investing in commodities was. As a consequence of that, I invest now on behalf of one client, me. I get along with him fairly well. He's an old, sometimes smart guy who stomachs volatility, who knows that he has to endure 50% losses, drawdowns, to enjoy 1,000% gains. He's got a huge sense of humor for that. It's interesting. When I was listening to Lobo, I was remembering a discussion I had when I first started doing a lot of business with Eric Sprott. We were having a liquid dinner, I will admit that, but I remember some of it. And I remember saying, part of what I've done as a lender, Eric, is I manage risk. If I manage my downside, my psychological and financial downside, the upside takes care of itself. And he started laughing. He said, I'm exactly the opposite. He said, if I have enough upside, I can afford a few losers. I'm somewhere in the middle now. I am willing to accept the possibility of 100% loss if it comes in the wrapper of a 20-to-1 gain. That works for me. I am much more willing personally to take ascribed political risk than I am technical risk. But I understand, as Lobo suggests, that I have the leisure of answering to one subscriber, Rick Rule, who, by the way, doesn't pay me for his subscription. That is an advantage.
Well, gentlemen, this has been another fantastic conversation. Let's touch first on the Rule Symposium, because that is happening right now. This will be the second day of the symposium by the time people are watching this. How can people get access online? And is there still a possibility to show up and get in the door right now, Rick?
Absolutely. If you show up right now, you can get in the door. But I would suggest it would be much easier to go to the Rule Symposium and join on live stream. Or if you don't have time right now for 12 hours a day of extremely intense and valuable programming, simply buy the recordings. Most of the stuff that you're going to hear at the conference is timeless. Last year we sold 210 conference tapes after the fact. Whether you attend live or via live stream, or whether you merely buy the tapes, It comes with an absolute money back guarantee. If you don't believe that we delivered value, we'll give you your money back. Lobo, this may be the only riskless transaction in financial services. So whether you choose to attend live stream, or the tapes, remember that you have your money back. Do not come to the conference. Do not give me money if you're a tourist. If you're the kind of person who buys the Sunday paper for the funnies and the crossword puzzles, this is not the place for you. We're going to give you 55 hours of programming over 4 days. It's going to be dense. It's going to be valuable. I put on the conference, and I have to play the tapes. So for serious investors, this is an absolutely riskless transaction. For tourists, go back to the funny pages.
Great. Well, I'm going to put a link in the description below where people can access that live stream. Lobo, tell us about the independent speculator and where people can find that.
For the 3 people left listening, let me just say real quick that Rick's not paying me to say this, but there is actually an added benefit to being there. Like Rick, he's very gracious with his time. He stands out there by the coffee table. You can talk to him. You can ask him your questions. I'm a little bit more pressed for time myself. I'm not quite so gregarious, or I'm antisocial, take your pick. But even I have a reception for my readers every time. And, we're there. And the Ross Beatties of they're there. You can talk to them. You can ask the CEO of the company questions that you invested in. And if he can't look you in the eye and give you a good answer, that's material. And if he can, that's relevant too. So there is something that's hard to capture in the live stream. So I'm just sorry. I just think that's important. If you missed it this time, please consider it next time. As for my thing, everybody knows I have a free weekly newsletter. I think it's called the Speculator's Digest. You may or may not agree with everything I say, but it is free. And the one promise I do make is that I will not spam you. You get 1 email per week, no flood of advertisements. And maybe if you like the way I think, you might consider hiring me to be your due diligence guy through my paid services.
Great. Well, I'll put a link to the independent speculator in the description below as well. Gentlemen, it's been an honor as always. Thank you so much for coming back on the show.
Thank you.